what happens to silver? Now, there should be a few disclosures here. A lot of you have found me through the silver community and have come to know me as a silver stacker, which I am. I still think that under any circumstances, silver will outperform gold. And the question has popped up recently with all this talk of gold revaluation, which really means debt revaluation. If there is an honest revaluation of gold relative to the dollar, meaning that everyone who has dollars, imagine in a world where everyone who has any amount of dollars can switch them in for a certain static, steady amount of gold, no matter how many dollars they have, and they can do this confidently, whatever the number happens to be, in that world where dollars and gold are interchangeable at a fixed rate with no problems for anyone who wants any gold for any amount of dollars. What happens to silver? Now, there should be a few disclosures here. A lot of you have found me through the silver community and have come to know me as a silver stacker, which I am and which I continue to be. Most, by volume, of course, most of my precious metals holdings are in silver. I have some amount of gold for stability and for my own mental well-being, though I stack mostly silver, and I'm still comfortable about that. Now, the question that people have asked me is what happens if there is a revaluation, meaning in a world where the dollar does survive at whatever exchange rate it is at with gold. What happens to silver? Some people have opined and suggested that the gains wouldn't be as high. I agree that the gains wouldn't be as high, but I still think that under any circumstances, silver will outperform gold. Here's our first chart for this video, and that is the historic gold to silver ratio going back all the way to 1718, 1715. That's around the John Law, Mississippi bubble, I believe. So you can see from about 1715, it looks like, let's say 1718, 1719, whatever it is, to 1873. This is the crime against silver over here when silver was officially demonetized at a statutory rate. The gold to silver ratio stayed around 16 to 1. It's not exactly that, but it meanders around there from 16 to 1 to slightly below. And more importantly than that, we've seen this ratio reestablish itself 3 times in the fiat era. Let's say there's no absolute definition for when the fiat era begins, but we can say that 1913, when the Federal Reserve was founded, was a big step in the direction of the fiat era. And so since then, since 1913, however you want to exactly define that year, again, everything is a gradient, everything is a flow. There's no real absolute definition of fiat, as there is no absolute definition of money. It's all a liquidity gradient. But anyway, in the fiat era, if we define that as 1913 and on, then we have silver at a 15, 16 to 1 ratio in 1919, 1968, and 1980. In 2011, we got down to about 30 to 1 at the peak, maybe 31, 32. That was the peak the most recently, about 13 years ago. We're going to get back to a 15, 16 to 1 ratio if the dollar completely collapses relative to gold. And why do I say that? Because we've gotten back there 3 times. Why not one more time? We have to examine what caused the gold to silver ratio to collapse to 15, 16 to 1 in these 3 years, and we'll see what would have to happen if we were to get there again. Now, the other thing you should notice in this chart is that we are near an all-time high in the gold to silver ratio. During World War II, 1940, 1941, the gold to silver ratio hit about 110 to 1, which means silver was ultra cheap relative to gold. We hit that at the peak of the COVID lockdowns in 2020 at about 110, 115 to 1. Could be said that this is a double top here. We hit it again in around 1990, 1993, which is around when Warren Buffett called for delivery on his silver stacks. In order for gold to get most of the gains from here, even if the dollar survives, we'd have to have a 90 to 1 ratio or above sustained from here through the end game, which I don't think is going to happen. It's very, very unlikely. It's theoretically possible, but in order for gold to even get more than half of the gains that silver would get, you would need a 90 to 1 ratio to be sustained or higher. If the ratio gets anywhere below 90 from here on out, then the gains in silver will outpace the gains in gold no matter what happens regarding a revaluation. The first question I want to answer here is, why did gold to silver ratio go to 15 to 1 in 1968? 1919, it was because of World War I. There was a silver shortage. We were still on a gold standard in the US, and silver was being used for the war. So there was a shortage of silver, and it was still used for coinage, and so there was a 15 to 1 ratio as silver was in peak demand. So we briefly went to a 15 to 1 gold to silver ratio back in 1919. But why 1968? So here is the price of silver from 1960 to 1970. You can see here 1960 to 1962, 1963. This is the Kennedy years. This is when he was assassinated, unfortunately. All the way through 1968, or 67 rather, we have what looks like a fairly controlled price for silver, and that is because statutorily, silver's price was controlled. It was controlled in the early 1960s up to 1964 because of the Silver Coinage Act, which remained, which meant that we still coined dimes, quarters, half dollars, silver dollars in silver, so the government had to control the price of silver. This is while it was printing money for the Korean War, leading up to Vietnam War, etc., etc., guns and butter and all that crap. So you see here that the price control gets kind of wobbly in the mid-1960s. Here is where the Silver Coinage Act was removed, but the silver price control by government mandate maintained itself until 1967, when it was finally released. And once it was released, because the government didn't need to coin silver anymore, by the way, the silver was still used in the coinage in 1965 until 1970, 40% silver coins, half dollars, but they weren't so used, but it was still in the coinage, at least officially. And so the big cause of the gold to silver ratio going to 15 to 1 in 1967, 1968, from that time, it went from $1.30 to $2.70. That was because this artificial protection of the silver price was foregone over here in 1967. It took a few years from the removal of silver in the coinage until the Treasury finally removed the silver price control. Once it did, all of the pent-up demand skyrocketed into 1968, and that's when gold to silver hit a 15 to 1 ratio. Or was it 16 to 1? Exactly what it was, I'm not sure. You could ask the question, why was the silver price controlled in the late 1960s if silver coinage had ended by 1964? It ended in 1964, so why was there still silver price controls? Because there were still several silver certificates that were redeemed by the federal government to people who had silver certificates. This ended in 1968, June 24th, 1968, exactly here, with silver at around $2.75 or $2.65 an ounce, and from there you can see that it went down. And once the silver certificate redemption ended, then the price of silver started to go down and the gold to silver ratio started to fall, as gold had a fixed price because we were still under Bretton Woods until 1971, whereas the demand for silver fell after silver certificate redemption ended in 1968. Now if we go to 1980, we can see that the manic panic phase was very short in the price of silver. It lasted from about June 1979 until January 1980. The whole thing was about 6-7 months if you want to count here. It was 7 months if you want to count to the peak. It was about 6 months. It wasn't very long. But why was it happening? Because faith in the monetary system and the fiat system as it had developed from 1971 was very, very shaky. There was a loss of confidence in the dollar as a viable gold derivative, and that's why silver went from about $8 to $50, and this doesn't even show the peak. It's about $50 here. It goes even higher than this. The manic phase was very short, and I expect it to be about as short this time. But here is the thesis that I want to explain. My thesis on the gold to silver ratio in an endgame scenario. An honest revaluation we could define as if everyone who has dollars is able to redeem them for gold from the government's vaults at a fixed rate without any problems. An honest revaluation, which I think is extremely unlikely, that will collapse the banks for sure, but it will keep the dollar basically functional. So new banks could emerge that take up the old capital of the old banks, and they function on the dollar system on a new gold standard. Silver will not be needed directly in this scenario. That means that silver coins will not be needed for retail trade. You can use dollar derivatives, whether they be digital or physical paper notes. Doesn't make a difference, but the dollar will still be functional. There will still be hyperinflation up to a certain point, and at the honest revaluation level, prices will stop rising for inflationary reasons. In that event, if silver is not needed directly, it will still rise. Probably the gold to silver ratio will still rise to maybe about what was in 2011, let's say 30 to 1, so it could rise to 30 to 1. So that means that silver will rise 3 times as fast as gold in an endgame scenario. But in that scenario where there is an honest revaluation to gold for the dollar and the dollar remains functional as a gold derivative, you got to look for a peak of silver value of about 30 to 1 relative to gold and sell around that target either for gold or for things you want to acquire in the endgame. However, if there is no honest revaluation and we just continue the inflationary process until the endgame, and that's how we get through it, through a hyperinflationary collapse, then bullet point 2, silver will rise as interest rates rise, since most of the dollar as gold derivative depends on the dollar debt having value. Since most of the dollar is debt, dollar-denominated debt, as treasuries fall in price and interest rates rise, the gold to silver ratio should rise with it. And we will hit a 15 or 16 to 1 ratio, which should be your peak target for acquiring things with silver or acquiring gold with silver. You want to start selling at, say, around 30, sell into 15, get rid of almost all of your stacks at 15, keep a little bit. Instead of 30 being your target, it should be around 15, but you sell as we arrive at 15. You don't sell all of it at 15. You start selling at 30, you peak sell at 15, and you sell a little bit less as we go back to around 30, 40, 50, whatever it is. But you triangulate around 15 as the peak. Bullet point 3, therefore, silver will peak on a debt crisis in today's monetary system. As treasuries lose value, the gold to silver ratio will peak, going lower and lower towards 15 to 1, and you will have a month or two probably to sell for gold, sell your silver for gold, or buy stuff at the peak 15 to 1 ratio. That should be your target if there is no honest revaluation. Bullet point 4, a debt crisis can either be interest rates rising to infinity, which would be the case if the Fed does not intervene. On that scenario, the gold to silver ratio will still go to 15 to 1, or the other possibility is that the Fed forces interest rates down to 0 as the dollar dies, and the gold to silver ratio will go to 15 to 1 anyway. There's only 2 possibilities. Either there will be a statutory revaluation of the dollar relative to gold, and we will hit something around a 30 to 1 ratio max in silver, and therefore silver will outgain gold by about 3 times, or we will not have an honest revaluation of the dollar to gold, and silver will have to replace gold for a retail transactions, and we will hit a maximum 15 to 1 ratio of gold to silver, which means that silver will outpace gold's gains by about 6 to 1. So the question is silver going to outpace gold by 3 to 1, or 6 to 1, or somewhere in between? That is the ultimate question here, whether there's going to be an honest revaluation to gold or not, whether we're going to need silver for retail transactions physically, as in coins, or not, or we can still use dollar derivatives. The question is only whether gold is going to go up 3 times relative to gold or 6 times relative to gold before it hits a peak. Once it hits its peak, whether it's 30 or 15 to 1 or somewhere around those numbers, that is when you want to sell as much as your silver as you can for either gold or capital or whatever it is that's going to be extremely cheap in silver terms. Remember, silver is not holy, it's just money. And once money is at its maximum historic value ratio, you want to spend it so that other people can have money and continue the division of labor, living off of your generosity, selling your silver for stuff or gold at the most profitable rate to yourself, which in turn will save the maximum amount of the division of labor as possible.